Well, thinking about retiring, and maybe think again as retirees are thinking about unretiring. Nearly 20% of retirees are thinking about going back to work. With high inflation combined with low savings, it's forcing people to re-enter the workforce. We wanted to talk through this recent study and this trend with our financial guru. We turned to Darryl Rose with the Rose Advisory Group in Schaumburg. Welcome back to the stream, my friend.
Thank you.
Are people really unretiring? It's got to be a difficult decision.
It's got to be awful. You have, the big party, and you walk out the door with your box of possessions, and then you have to go back to work. So it does happen. It's got to be mortifying. I have a client who is working in a golf pro shop because he gets to play free golf. But yeah. I think in the case of some of the articles we're reading, we're talking about something completely different.
Yeah, the study by Paychex found 55% of retirees went back to work because they needed more money. And now some of those, I'm sure, like you said, I know guys that go work at golf courses for the free golf, but some for legit reasons: higher inflation, market volatility, lack of health insurance. What mistakes are people making when they decide they're done working? Why are they really almost prematurely retiring?
I think they're making the mistakes 3 to 5 years out. I don't think the mistakes are being made when it comes time to retire. And if you think about landing an airplane as an example, right? The work begins at 10,000 feet. It doesn't begin when you're 100 feet off the runway. And so what's interesting, Brad, is when we think about inflation, I haven't had a single client call me and ask me to send them more money each month from their accounts to cover inflation. I think people adjust. I think the major mistakes that people are making 3 to 5 years out is they're not considering something called timing risk. Timing risk takes into account the fact that if the market does not cooperate in the year you retire, you're going to get hurt. And all we have to do is look back at last year, 2022. Your viewers probably know it was not a very good year in the market. The S&P 500, which is the most widely known and followed index, was down almost 20%. Mm-hmm. So if you contrast that with a year where the market was up, say, 10% or 5%, the person who has not set themselves up to be able to draw money out of their portfolios in a way that is not being hurt by a down market, that's the person who's going back to work.
So let's say I want to retire early. How do I avoid those mistakes? I got to think like one of them is likely healthcare. Like you can predict your monthly groceries, but not the onset of a major health issue. Right? That's got to be a major discussion to be had.
Sure. We're always talking about healthcare. I think it's not really understood. So when you turn 65, so if we're assuming you're going to retire at 65, Medicare will kick in at 65. It doesn't cover everything, but it's a very good program. The problem, and I have clients all the time who say to me, I want to retire at 62. Can I do it? Right. Well, it's all math, Brad, but we have to know what those costs are. We have to know how much we're going to pay, what co-pays are going to be, doctor's visits. Of course, we have to have emergency stash for an unexpected illness, but I don't think that it's healthcare that would be the detriment. I think that it is creating income or understanding how our retirement portfolio is going to generate enough money for us to cover the gap between what we need and want to spend and what Social Security will pay us. Okay. I think that if we fill in that gap, if we look for solutions to fill that gap, and then we're not held hostage to the stock market, the ups and downs, and we can be what I consider to be more important than anything else, comfortable.
Right. And let's switch gears now. It's a terribly interesting conversation because I know more and more people retiring early. I mean, because there's a boom, there's this disparity in wealth too, and a boom for many people. But then still there's this question of people just want to do it a couple of years early. So that's a conversation we'll return to one day. Let's go to inflation. Have the rate hikes from the feds, have they been working? Have they actually managed to bring down inflation while avoiding this recession? Are we out of the woods? Have we avoided the big R, or is the R still on the table?
It appears so. There's a big report coming out next Friday on gross domestic product GDP, which comes out every quarter. So the second quarter report is coming out Friday. That will say a lot about the economy and whether the economy is growing or contracting. So a recession is technically when there's 2 straight quarters of the economy contracting. So, but we're seemingly working into a better place right now. The last inflation report was about 3%. It's more normal. The Fed wants 2%. They're always working towards 2%. The key, Brad, is will there be a soft landing? Economists use this phrase soft landing. Will there be a soft landing where the Fed can bring interest rates down over time, inflation is manageable, markets are calm, and unemployment stays where it should be?
So I'm not going to ask a $64,000 impossible to know question when a rate's going to be what. I'm not going to say, when they're going to be back to X percent. But when do they come down? I mean, let's say I'm buying a home now, paying 7-8% or more than that. How far does it need to come down to make refinancing worth it? And what's that window look like? Because right now people are like, this is astronomical, right?
Right. Well, the interest rates have actually risen a little bit in July. It's at about 6.96 for the 30-year. And Morningstar, which is a fabulous source of information for consumers and professionals in the industry, suggests that in 2025, the rate would be probably around 4.5%. Brad, it's a tricky thing because, when interest rates were so low for so long, that's good for home buyers, presumably. It also can cause people to spend more than they should because they can get more house.
Free money.
The other side of that, Brad, is that the savers can't earn anything on risk-free investments like CDs and money markets. So the Morningstar has the 2025 projection at about 4.5.
All right, got to cut you off.
So it takes a little bit of time.
Okay, thank you. Darryl Rose, friend of the stream. Thank you for being with us. Thank you for being a friend. We will have you on again soon.